Okay, we see it.
Excellent. Okay, thanks for bearing with me. Hi, everyone. Good afternoon. I'm Safa Rashtchy. I'm talking to you from Palo Alto in Silicon Valley. My colleague Puyo Moradi is also on, and he can answer some questions. I am here to tell you about a unique venture capital opportunity that's based on the trends that we have identified, especially post-COVID. This is our Fund 2. And let me move on first with the legal stuff, that this is not a formal solicitation. So our Fund 2 is a unique opportunity that leverages what we have had as really an unusual gain in our Fund 1. Our Fund 1 is up 4x or 100% IRR, and we launched it in late 2017, 2018. And what has helped us is the fact that we are research driven. We don't follow what is hot here in Silicon Valley or elsewhere. We actually find the areas that we believe are going to be the next key pain points in the market in the next 5 to 10 years and invest in those. So I want to actually tell you about what we have found in the past year or so. This is from a piece that we published back in November. Many of you are familiar with what's in the reports, what's in the news these days, that we actually have seen a major shift in productivity, major shift in adoption of digital platforms since COVID. But we wrote this back in November saying that, look, this is not a transient trend here. What we have seen, there's basically a trinity of factors that will create a sustainable growth for the next 5-10 years. That includes increased productivity because of increased automation and adoption of digital platforms. Companies were able to do things a lot faster than they could. And we actually have examples of those in our own portfolio companies. And of course, combine it with the fiscal stimulus and low interest rates, we are seeing tremendous growth in the areas that we're looking at. What are those areas? They include these 5 sectors, but we go beyond these where we see any major pain point. Digital health and fitness has been a focus for Think Plus since we founded the company in 2017. And obviously it got huge tailwinds because of the adoption that was done during COVID years. E-commerce infrastructure is needed to be really upgraded. We've seen a tremendous uptake in all kinds of e-commerce activities, from deliveries from supermarkets to Amazon to all other kinds of online deliveries, and the infrastructure is barely keeping up with it, from the logistics to online to deliveries, to last mile deliveries, to warehouse, to customer support. All these things are areas we have looked at, and there are promising companies in those sectors. Beyond snowflakes, there are new applications in the cloud area now that most companies are moving from on-premise to cloud. And finally, Edtech and Fintech are 2 areas that we really think will be taking off in the next 10 years. Fintech has already started, and Edtech is really one that we are very hopeful, because it will not only address major problems in the society with so many people being out of work and really unemployable or underemployed. They need to be retrained. So we're looking at models that can actually fill that gap. It would be a great benefit to the society and a huge economic opportunity for investors as well. Our Fund 2 is going to be 30 with a cap of 50. We are early stage, which means seed and Series A. And as I mentioned, we are market driven, which I will explain more. But let me first tell you what we did with our Fund 1. This was a small proof of concept, sub $10 million fund that we launched. And as I mentioned, we have already had 4x return on it, 100% IRR. What's most important is that we have had 2 unicorns and 1 exit in about 3 years. Our companies went on to raise another $1.1 billion after our funding. And most importantly, what you don't really see in funds of our vintage is we have already returned 16% of the capital to our investors. This was possible by companies like Signify that I invested in at $4 million. It was recently announced they raised money at $1.4 billion. This is an e-commerce infrastructure that finds potential fraud transactions very easily. Applyboard has been our biggest winner by far. We invested at $12 million in 2017, one of the first companies of Fund 1, and it is now valued at $3.2 billion. Tubi TV was our first major exit last year. Actually, in the middle of COVID, it was sold to Fox Media for $500 million. We invested $12 million. And PayJoy, I believe, is our next unicorn. It's a great fintech play that is also part of an inclusion platform that we subscribe to. It brings in people who are not able to buy their phones right away, gives them a very low interest rate with the ability that it can lock the phone if they don't pay the interest, the monthly payment. Therefore, it can offer them a very low interest rate. The company, we invested at $4 million when they were just forming it, and now it's worth at $625 million in the last valuation. We believe this is on its way to a multi-billion-dollar company. This really shows our tremendous growth. This is really similar to the kind of hockey stick charts that we like to see from the startups we invest in. We started with a small first close of 5 million, followed up with 6.5 million close in 2018. By 2019, we already had a first distribution. By 2020, we had our full exit at Tubi and our first unicorn. By 2021, we had our second unicorn, and the fund is now worth about 25 million. What makes our model confirm that it works is the fact that our seed investments are followed on by major and larger later stage firms such as Andreessen Horowitz, NEA, Greylock, and others. And to compare our fund with the funds of our cohort, you can see that they really were off the chart. I mean, the top quartile of the funds, according to Cambridge Associates in 2017, has an IRR of 20% compared to our 100%. There is almost no DPI, no distribution of the funds at this stage, and we are at about 16%. So our thesis is pretty simple. We invest in major pain points in the market, that is solutions for these major pain points that are offering efficiencies, that are capital efficient, and have positive unit economics. This is different from most early stage funds who only invest in people. They say we invest in entrepreneurs, we only invest in people. We don't, we invest in market pain points, and we find the right people and the right solution with the product market fit. A little bit about my background. I've been around for a while. I was on Wall Street for 10 years. I made my name in there as a top analyst, took companies like Google and Alibaba public. Since then, I've made several investments, including several that have been sold to public companies. Our team also includes very capable people, 2 associates and 3 venture partners from industry, as well as people I've known for many years, such as Vic Maida, a major hedge fund manager in New York. Eric Benamou was the CEO and chairman of 3Com and Palm, and is the partner at a major venture firm here, but he has invested in our firm as well. Uli Chatipilli is a physician with Kaiser Permanente, and he helps us on our medical side. So Fund 2 that we're raising right now is a $30 to $50 million fund. Again, seed and Series A will invest in about 21 companies with average check size of 600. And what's most important, that we actually already have 2 investments warehoused for it before we do even the first close. What our advantage is that allows us to get this kind of return is that we are heavily networked with the Silicon Valley. We get a lot of deals from Stanford. We have a track record which attracts top entrepreneurs, even from kind of coveted areas like YC. And also, we're known to do our own research. In fact, we share that research with our portfolio companies, and we are market focused rather than just entrepreneur focused. And this is shown. These are some of the investors in our Fund 2, the fund that we're raising right now. Famous people like Lee Fixell from Tiger, who started his own Edition fund. I've known Lee for a number of years. I think Lee sees this as a potential feeder to Edition. Narges and Farhad are both CEOs of our previous portfolio companies who had great exits, and they decided to put some of their money here. Bernat Brothers, who basically created the Lollipop in Spain, is a major family office in Spain they have invested in, as well as friends that I mentioned, Vic Maida Eric Benamo. These are just some of the few investors in the fund too. I mentioned we have two companies that we have already in warehouse for Fund 2. This is one of them. This is really the future of delivery, online delivery of food and other items. It's called Serve Robotics. It was recently spun off from Uber. We have known the founder for 7 or 8 years. He's a top robotics expert. And with this robot, you can get the delivery cost from $5 to $8 right now to down to about $1 or $2. We firmly believe that delivery problem has not been solved yet, and solutions like this are needed to solve that problem. So that's one company already in Fund 2. The second company is in education technology called Critique. It already is generating revenues in Canada, and it is a unique platform that allows collaboration among students and professors and creates a much more dynamic environment for learning and teaching. It's been very positively received by people at different universities. We did a lot of interviews with professors before we invested in them, and they said we definitely need a platform that allows students to collaborate. It helps us create better homeworks for them. It helps us improve their performance. And the founder has been an experienced founder. So these are the kind of things that we find that I think are really unique to our model. I want to end quickly so that I can open the webinar for some question and answers, but I do want to emphasize that we are doing our first closing on September 15th. My email is safa@thinkplus.vc, so please let me know if you would like to get some more information on this. So Marty, I wanted to finish quickly. I'm hoping that there would be some Q&A here.
Safa, I think you went too fast, but
Okay.
number one, congratulations on Tubi. And what made you invest in that? Like, how did you get the deal flow to see these ventures? Because I know like USVP invested in Pluto TV, and it was a huge success for them. So what led you to Tubi, and what was your thinking at the time you invested in them?
Yeah, that's a great question, because as I mentioned, we are thesis based. So let me stop sharing the screen here for a minute. Okay.
So you're still on screen share?
Yeah, okay.
There you're off. Okay, got it.
We invested in Tubi TV, and I was introduced to them by one of our co-investors here in Silicon Valley. But we invested in them because it was our thesis that with so many paid online streaming services, we needed some free ones for the middle class and the lower classes who can't afford to have an Amazon and a Hulu and a Netflix, and advertising base is supporting this kind of payment. Most people didn't believe that ad-supported online streaming would work, but that was our unique thesis that allowed us to invest. In fact, my background taking Netflix public also helped me to advise the founders early on how they should really increase their interaction, increase the user base, and rather than focus on the revenues right away. And that led us to have an opportunity to invest in the follow-on round as well.
So how do you know who's going to invest upstream from you? I mean, I imagine you don't invest in anything unless you know how to sell it ultimately, right? So, who are the upstream buyers of what you're looking at?
Well, when we invest in, we look at a company and we say, is there a path to $1 billion revenue for this company or not? Of course, very few companies can get there. But if we don't see any path possible at all, we don't invest. If we see such a path, then there is really no question in our mind that either there will be acquisition of the company, or either there will be an IPO, or certainly in the follow-on rounds, we will get major investors coming in. When I invested in Apply Board, that was the case. I didn't know about the market. I flew to Canada, met with the team, and looked at the market, and I said, there is a demand for connecting foreign students to universities. Right now, it's a completely offline, highly inefficient model, a tech platform that allows people to apply directly and get their admissions is certainly going to be worthwhile. And this company can get to $100 million. In fact, they did that this year. They were $100 million revenues. So that's really our test. It isn't so much that we would shop it around and say, would you be interested or not? We actually look at the companies and see, is there a potential for this to be a large player or not?
Can you talk about your deal flow? I mean, are you like working through accelerators or, angel
We do
list
everything.
or
I mean,
any
to
one
be
of the
honest
many?
with you, deal flow in some ways I would say is a solved problem. If you're an established player like us, if you're an angel investor, it's still more difficult. But once you are part of the network here, we get to see most of the deals that others do, but we also get to see some deals that others don't because we look beyond Silicon Valley. We have investments in UK as well as in Canada. About a third of our deals come to us directly because they know us, because we publish thought pieces and research that they know us. About a third of them, and these are really the best ones, come through our network. And it would be the same for any successful VC. Their best deals always come through their network of other VCs, network of entrepreneurs we have funded before, and networks of current entrepreneurs in our database. We have 600 entrepreneurs who receive our newsletters on a monthly basis, and we're in contact with them. They were companies that they presented to us and we passed, but they keep in touch with us. So that's the best area. And about a third of the deals, we go after them because we go through every deal possible that's been announced, or when we see some talented people leaving a major company like Palantir or Instagram, we go after them and say, what are they doing? So 1/3 of our deals we go after. So it's a mixture of all three of them.
So when you're investing in groups, I mean, so do you weigh credentials and past achievements versus for the management team versus thematic, like what you're investing in, or how do you reach that?
Yeah, that's a great question, because every VC I think does it differently. Our approach is that when we see a founder, we want to be impressed by how he or she is really focused on solving the market pain point. They're almost just completely taken off by the fact that this pain point has to be resolved and they can do it. As opposed to many founders who come to me and say, this is the product we have, and they're in love with the product and technology. In many cases, those are solutions in search of a problem. So we want a founder who is really looking not at his or her own platform or product, but at the market, and is convinced that this is a big pain point and it has to be solved. We just had an interview with such a founder who left Facebook, a brilliant AI engineer, who says, look, there is a major problem in protein folding, and we are going to solve that. I don't know if we can do it or not with this, but I know that's a big problem. So we want a founder like that who is really, really driven, visionary, and is convinced that there has to be a problem, and even if what they're doing is not the right one, and they're going to solve it. We also look for founders who can build a team. That's really important. We want a founder who can move, who will have a second act and can move quickly. If somebody just wants to basically get to a certain level and then sell the company, that's not the right founder for us. In many cases, that's a good investment for angel investors. But for us, we need to see a path to $1 billion company.
So like basically the market opportunity matters in terms of the size, right?
Exactly.
Of course.
Yeah.
And so can you talk about co-investment in your deals? Because I think Silicon Valley approaches co-investments radically different than East Coast firms. So talk about the size of co-investment and how widespread it is with what you guys do.
Yeah, we may be different in that we actually welcome and we ask our LPs if they would like to do co-investments. To us, there is no downside to it because we're early. We're kind of downstream in the investment cycle. So I was listening to your earlier panels. I think there is definitely benefit to get more investors out in there. So whenever we have a chance, we offer it to our investors. We don't charge anything for that. And sometimes on the follow-on runs, when either it's just too expensive for us or too late stage for us, we actually offer our pro rata to our co-investors. So that's kind of standard practice for us, that if you're going to invest $500,000 in the company and the company is raising $1.5 million, and we really like it, we'll say, look, we can probably get you another $500,000 or more from our investors. Are you interested? And if we get the okay, then I make the calls and we do it. Sometimes it would do SPV if it's a larger size, but typically we just like to offer it to our investors, because to me, that's really part of the value of investing in an early stage VC, that you get access to those deals.
Right. So, I mean, so you've talked about, deal sourcing and, the network and everything else. So can you talk a little bit more about like what you see as the areas you're going to focus on primarily in a near future, like your deal flow that you have today, why you're raising another fund, what's your capacity on the deals that you have, et cetera, in your pipeline?
Yeah. Yeah, our pipeline is pretty strong. I mean, we have a team meeting on Fridays, and every week we go through those. We usually have at least 5 or 6 deals that we will review there. Basically, our pipeline has been pretty standard, that every year we screen about 12 to 1,500 deals. And screening means that we get a one-pager, we get a deck, we review it, we say, is it worth looking at it more or not? Out of those 1,500, we usually have calls with about 300 to 500 of them on a yearly basis. Out of those, we do due diligence with about 50 or 60, which means that we would have follow-up calls. We actually invest some of our time and our analyst time to do the research, to do market research, talk to their competitors, talk to their customers. And that's really the bulk of our effort for those 50 or 60. And out of those, we invest in about 5 to 6 at most. Usually it hasn't been 6, even between 4 to 5 per year. In terms of sectors that we're looking at right now, as I mentioned briefly, and I know I went a little bit fast, I was worried about time here. Logistics and the last mile delivery is really an interesting and unsexy area that I think has yet to be solved. This is a major 5 to 10 year problem. We see companies like DoorDash out there, and we think that's it. Delivery has been solved. Instacart, DoorDash, Amazon are there, but that's a highly inefficient way to get things to people's door. We have invested in a company called Buckspot, which all it does is they do a very smart sorting of the packages just before it's put into the truck for the last mile delivery. That by itself is a huge opportunity, and it can cut the delivery cost by about a third and make it about a third faster. So we think that there are ways to do aggregation of deliveries from various vendors to come in. That's one area we're looking at, and we have several companies in there. I mentioned retraining and income sharing agreements that are going to be part of training millions of people. We still have about 5 to 10 million people who basically either lost their jobs after COVID or are underemployed. And those people need to be retrained. And retraining doesn't mean just teaching them how to code. Retraining means that you bring them into the fold, into a new industry, teach them the lingo and how to network with new people. So we're looking at companies that can actually do that. Digital health and fitness is a major area for us. We have a few investments in there, frankly, not as much as we like. So we're looking at those areas where you can provide both remote as well as a combined remote and holistic approach of providing fitness, healthcare, mental health, women's health issues. So these are some of the areas that we're looking at that are not necessarily the top of the mind for most other VCs.
Safa, I'm going to tell you about this whole digital fitness thing. I just joined, I do a lot of running. I just joined a group on Facebook of people that were 50 plus and runners, and they are crazy and insane people who run 10 miles a day. So it definitely need this stuff to be working, because I think they have, like, I'm going to tell you, 1,000 comments a day in this one group. So just the amount of people participating is off the charts. Because and obviously we were in San Diego. It must have been 4 or 5 years ago in La Jolla, and we were covering the same topic about, because San Diego has so much innovation going on there. So we're covering the whole topic of shared fitness groups and sharing information. And I know it was nascent back then, but I think now it's become pretty interesting. So that's a great place to be.
Right.
So can you talk a little about geographic differentiation? Because I mean, as much as you're differentiating yourself by investing in different geographies, at the same time, isn't it kind of a little bit hard to chase down, or has that become simplified with Zoom and the web, et cetera?
No, I have to clarify that we don't actively look outside Silicon Valley, but we are open to it. So we opportunistically invest in other areas. We can't really overstretch ourselves. But there are firms, and many of my great friends with whom I co-invest say we would not invest beyond even Silicon Valley, let alone, beyond Silicon Valley, let alone California. So when we get a deal from Toronto, for instance, there are great talents out there in the University of Toronto, Waterloo. When we get someone referred to us who happens to be in London or Spain, we take a good look at it. And if it's something that we like, if we understand, if we know the competitive market, we invest in it. But otherwise, our biggest focus still remains US, not just Silicon Valley. We look at Florida. Certainly East Coast is a great area for us, and Texas, and we would be sending some scouts to different universities in the US to find deals in those areas as well.
All right, there's a private equity firm based out of Los Angeles that's incredibly successful, but one of the things they say is that their best investments come in underexploited, undercapitalized university areas, where there's a lot of great people who have been educated, like for example, Raleigh, Durham, places like that.
Yep.
But there's just not a lot of capital, and so what's interesting is that you're in this area where there's a foreseeable path from C to Series A to Series B, et cetera. If you go to Austin, Texas, or if you go to Raleigh, Durham, or if you go to Nashville, Tennessee, or Memphis, Tennessee, not necessarily, even though there's fantastic medical, robotics, et cetera, institutions in the area. So,
yeah, look, I want to stress that we invest the way that in what we're good at, and what we're good at is understanding trends. There are a lot of people who are good at picking up the right entrepreneurs. They're networked, they know the right people. There are other people who actually do thematics. Whatever is hot, that's a theme, and they invest, and that worked for them too. I made my name on Wall Street when I was the first analyst to say search is going to be a multi-billion-dollar market. And I met with Google co-founders when there were 12 people. So people would put out my report saying that Safa got the golden search report. And that's really what really matters here, because we know it's going to be good. Then I went to China and started looking at the Chinese companies when nobody else was looking at it. So to me, it is not necessarily finding unexplored geographies, unexplored founders. We look at what is going to be the big problem in the next 5-10 years. Central banks are going to introduce digital currencies. That's the given to me. So to me, what we're going to spend the next couple of years is, how is that going to change the banking landscape, and what kind of opportunities is it going to open to people in the fintech environment? So that's an example of the kind of thing we look at. When I wrote a report in November about the new S-curve, I really saw that the millions of people who came online during COVID, they were almost what we would call forced free trials. People like Netflix would spend millions to get people to try their system, and usually they would have 20-30% of them who would stay on, and that would be cost of acquisition. With COVID, these companies were able to get millions and millions of people for free to try them because they had to, and many of those people stayed on, and that pushed the S-curve up to another 5 to 10 year growth. So we invest in those patterns rather than geographies or people or on kind of on other things. And those things work. I'm not saying that they're not good investment strategies, but ours is different.
Do you have any thoughts on alternative media like podcasting or gaming or things like that?
We haven't really spent a lot of time on those. Those are great areas as well. Creator networks, companies like Clubhouse. I don't have a strong view on this, to be honest with you, because we have had so many other great opportunities we focused on that we didn't really go into.
Sure. Fantastic. Great. I'm not sure there's any other questions, but maybe you can just wrap up with some parting thoughts for the group.
Sure. So as I said, we're doing our first close on September 15th. We have great investors out there. This is really a way to play Silicon Valley in that it would be differentiated from other ways of investing directly, and yet you're exposed to the key trends. So basically, to me, we almost are a sub asset class within the VC asset class because we look at the longer term trends. And I think with that, we're able to minimize the potential losses because we look at the product market fit. And that's the main reason the companies fail. They don't fail because you had the bad founders. They fail because you didn't have the product market fit. So that's really my parting thought.
And what's the size of the fund again that you're
The fund
raising?
is going to be about 30 million minimum, but between 30 to 50 million. The check sizes from individuals is minimum 500,000, institutions 1 million.
And can you talk about pro rata rights and how you are they preserved into the next round? Because I think every family office on the East Coast kicks themselves when they're not in a West Coast fund that gets a unicorn like you have had a couple.
Yeah.
So they're like, oh my God, why did I do that? And then they want to be able to invest in the next round as well. So we had, I think, a fairly well-known micro VC from 10 years ago who has since raised lots of funds present to our group. And so he said, one of the family offices, we're a $10 billion family office. There's no way we can invest in you, but we'd love to have rights going forward. And then maybe at the third, at Series C, this makes a lot of sense, right? So any thoughts on that? How you preserve that, or what your expectations are going forward?
We preserve it to the degree that we can get it from the company ourselves. So we usually insist on that. If we are leading, we will certainly get that right. But bear in mind, we are early stage investors. So at some point we would be diluted and the larger firms will get those rights. So when we do get them, we would love to share it with our investors. In terms of the right to invest in the next fund, that's something we certainly keep. All our first fund LPs had a chance to invest, and about 80% of them invested. The only few who didn't invest were really just doing different asset classes. So certainly for the fund, we keep the pro rata for the investors. For the companies, whatever we get, we'd like to share with our investors.
Great. And can you give me, so just as the last question, can you give me some perspective on areas where you see there's absolute green fields, for investing right now, like really revolutionary, like a 0 to 1 style investing that you think are big, whether you're investing in them or not?
Well, I really think it is within the biotech area. It is a bit complicated, but I think that we're in the early stages of the next phase of understanding how proteins work and how drug discovery can be made, and actually how these things work inside our body. Genomics made a great revolution, but we haven't really reaped the benefits of it. So I would single out that area. There are a ton of other areas like AI-enabled diagnostics are great, but I think that in the next probably 10 years, not 5 years, but 10 years, we would have dramatically different landscape for both disease discovery, drug discovery, as well as treatments for those, because we actually will understand how these proteins interact with each other.
Yeah, obviously, and there's things like CAR T therapy that's been revolutionary. And I just want to throw my own perspective, because I'm in Silicon Valley a lot, is that AI assisted learning is going to be so pervasive in 10 years. It's really going to make us rethink how people get educated, because anybody who plays online chess, etc. I think that since AI kind of solved chess, there's been more grandmasters created than any point in history, because it's solved and people now understand what the problem is they should be seeking or trying to solve, etc. So it's really fascinating. These are interesting times.
I would just give you some final thought on that, since you raised it, is that among all the AI applications that's been announced, including the DeepMind doing the big game that they won, the most significant one, that's right. The most significant one was actually the AlphaFold, which was recently announced. That Google's DeepMind was the first platform that was able to get about 80% of the proteins properly described in terms of the folding. That, according to many people, has been by far the biggest achievement of AI, but it has received little attention. So